And we are live. Hello, everyone. Welcome. Good to see you. Chat's already live. We just got started. Sound check. 1, 2. 1, 2. Great to see everybody. Let's do this. Hello. Welcome, friends, to Alpha Beta Soup. I'm TXMC. How you doing today? Happy New Year, everyone. It's 2024. Welcome to the first stream of the year. Chat was live before I even got started today. John Sinden decided to join the channel memberships. Welcome, buddy. Sean gifted a membership. Welcome. Absolutely, Rufus. You got it gifted from Sean. So, we'll look around the market a little bit today. We'll check in on a little bit of the jobs report because I know I saw some of you guys mentioning it in the chat before the stream. But today I'll probably spend most of the stream. I kind of want to talk about some bigger picture ideas about the inflection point that it feels like we're at this year, this decade. Just kind of things that I've been thinking about as we enter this new year. So we'll talk about some of those things. And then after the stream today, we'll figure out the time as we get closer to the end of this stream. But what I want to do is the first member stream. So for those of you who have decided to bless me with your very generous channel subscriptions, we'll do a private stream after the public stream today, maybe 30, 45 minutes later, and we'll just hang out and do our thing, all right? We'll do the first one. Kick it off. If you want to join the channel, well, Brandon, your name's already green, so you are a member, my dude. If your name is green, you are already a channel member. And you'll be able to watch the stream after this. You'll see it. If you're looking to join, then you can go to the channel and there's a join button. Or someone in the chat might be generous enough to gift it to you. But what we're looking at today, man, I've been watching the stock market a lot just the last couple of weeks here because it's got people a little nervous. You know, if you're someone who watches the price charts. There's a lot of people in the markets who don't pay that much attention to the charts, which is surprising to me, but I like to watch them a lot. And we're in a really, we're in kind of a nerve-wracking place because, the S&P obviously is just below its all-time highs, but the futures S&P has already broken it. ES has already broken its prior all-time high, whereas the S&P index isn't quite there. But the NASDAQ on both NQ and NDQ have swept it. And not only have they broken above, they've now come back down below. So, what I'm watching here is to see how deep does it pull back? Does it come down into this zone before it bounces higher? I do think we'll get another high. Like, even if I have an idea about the market having a negative outcome this year, even if I think there's a recession, I do still think there's probably at least another leg higher on NASDAQ. I don't see why there wouldn't be. But after a massive Q4 ripper like this right here, it makes sense that if we're going to break the all-time high on that move, that we cool off a little bit before continuation. That's just physics, right? That makes sense. So even though we're at a really tricky spot, as long as we don't see a lower high form and then a lower low, so like, let me remove this. Let me use a better drawing tool. Let me use my one that's not attached. Here we go. So we have the all-time high here that got swept, right? And we've now broken below it. Structurally, what we'd be watching for, what we wouldn't want to see is a lower high form and then a lower low form off of whatever this low is. Wherever this forms and turns around, maybe it comes down all the way down here before it starts to do that. I don't know. We wouldn't want to see this right here. This right here. Lower low, lower high, lower low. So right now, just kind of watching, see where the bounce is, where the support is. Maybe it's 16,000 here on NDQ. I don't really know. But I'm not going to spend too much time on this today because we've been expecting the markets to go higher. And even if we have a thesis that we're near the end of a secular cycle, I don't think we're actually quite at the top yet. But it's looking a little nerve-wracking up here. This is like a place where I am more nervous than I was at any point back here, because I think we're getting near a point where it's kind of make or break time for certain ideas, including my own, about what's going to happen this year and, the next few months. So that's kind of all I have to say about the NASDAQ right now. Same thing with Bitcoin, just kind of hanging around in the same spot. No new updates. We had a big flush the other day, and it kind of hit a lot of crypto. But if you look across at all the different coins, most of them maintained market structure. So like they got a nasty wick, but then the candle closed higher than the previous closes. So the structure, it was still largely intact, even though we had this quick wipeout on what seems to be a fake news report about all the ETFs being rejected. I think they're probably going to get approved. There's been so much interaction between the SEC and all these applicants at this point, far more than there ever was in the past, that I think it would be a surprise at this point for them to have led on all of these different firms for this long, only to rug pull them in like the 11th hour, including people like BlackRock. I think Gensler and the SEC would make a lot of enemies doing that, and I just don't see that as the most realistic thing to happen. I do think the ETFs will get approved, but alas, there was a fake story yesterday or the day before. Maybe it was yesterday, or it was Wednesday, excuse me, and we had a big dump in the market right after that. Maybe it was caused by it, maybe it was coincidence. Either way, but I think Bitcoin is going to go higher when the ETF gets approved. I think it'll get an immediate reactionary pump. How high it goes, I'm less sanguine about. I don't think that it's just going to confirm a new bull market. I still think largely that we have to work through some key retracement levels that we still have yet to see resolved, right? I've talked about this a lot. I don't say it that often because I don't like to be too repetitive, but you guys have heard me say this a bunch, that like this area is the scary area and we're not even there yet. So until we do, I assume we will eventually get there, especially with an ETF announcement just potentially a few days away. We did get a jobs report today. We got a jobs report. Different, kind of some different dynamics in there. Like, I'm not going to go through line by line of all of the differences on the jobs report, but there is something that I thought was interesting. So let me put these on the chart here together. I didn't have this ready. So let's zoom in from January of last year. So something that's kind of interesting is that, so you got these two different surveys that make up the labor market, right? There's a lot of data that makes up the labor market, but the two primary like headline job figures are non-farm payrolls, which is the one most people look at, and then what's called employment level, or also sometimes referred to as the household survey. And those two figures combined kind of tell the overall aggregate story of job growth and job totals for the nation. And so the non-farm payroll number, that's the one that mostly gets reported. That's the one that has a lot of built-in smoothing. It's got an estimate in part of it that's called the birth-death estimate. It's a birth-death model that makes a bunch of assumptions about job growth in businesses that have just opened or have just closed, because that data is not always known in real time. So the series, the non-farm payroll series, it builds in all these assumptions about what job growth is actually doing until it gets those figures. And so that series tends to be a lot smoother. The employment level, which is the red one on this chart, is what's called the household figure, and that one tends to be more volatile. It also has lower survey response rates, but it doesn't have as much seasonal adjustment and built-in assumptions to it, so it's a more volatile metric, and that's true going all the way back in time, which is why I look at both of them. And when we do our recession modeling together here in my workbook, one of the things we've looked at the most is called what I call employment composite. You see that up here? That's actually me blending these two together because they don't go in exactly the same direction. and they tell slightly different stories, right? But if you make an average of the two, I think you get a clearer picture. Well, the interesting thing today is that non-farm payrolls, it registered another positive growth, but employment level, the red one, it set a lower low. For the first time in this saga meaning the post-pandemic possible recession, Fed tightening that we're going through. This is the first time we've registered, I hate this tooltip. Can I turn this tooltip off? Yes. So the first time we've registered a lower low right here. Do you see it? It's right here. Oh no, that's white. Here we go. It's right here. We registered a lower low right here on the chart. Low, high, lower, low. And we haven't done that yet. Now it's just 1 month. And this isn't definitive. This isn't going to change any of our outlooks or confirm anything. But I think it's interesting that non-farm payrolls registered a new high, and a bunch of people on my Twitter feed are saying, oh, where's the recession? And maybe it's not here yet. But the other figure in the exact same report just registered a lower value. And in fact, it is the lowest value since July. So that's noteworthy. That's something worth pointing out. And it's the first time this whole series, I mean, I can zoom this out a little more. It's the first time since the beginning of January, when really this whole saga began. First time we've had that lower low. We had a low here, but it wasn't below any prior pivots. You see that? It just kind of registered a couple of declines, and then it continued. This one actually went below multiple months of values. Now, I don't know that means it's just going to roll over. But there's weakness in one part of the labor market. There's strength in another. And the interesting thing about this non-farm payrolls, I told you that there's assumptions built into it. The birth-death model, that thing that tries to guess a bunch of the job growth, is responsible for over 40% of all of the jobs that were added to this non-farm payroll series in 2023. That's a lot. That's a lot. People don't really quite get that. From January to December, over 40% of this increase in this line is from a calculation that is making guesses. And if you look at the revisions to non-farm payroll, so every time a number comes out, they revise the one from the month before. Sometimes they revise 2 or 3 months in the past. Sometimes there's a big revisional wave and they'll do a whole year at a time. But each month that non-farm payrolls comes out, they revise the prior one. And in 2023, 10 of 12 months were revised downward the next month. So like the initial figure comes out for March, and then in April, they say, oh yeah, by the way, that number for March, it was actually smaller than we said it was. So everyone gets really excited when we have a new NFP number and it's a bigger number than expected. They get really excited. And that's not a negative thing. I mean, it's positive job growth. However, it is important to know that there are a lot of assumptions built into that model, and that almost half of the growth in here is from assumptions in a calculation. Some of it may be true, some of it may be not, but we've seen 10 of the last 12 NFP prints get revised down. The only ones that weren't were April and August. All of the others were revised downward. So this newest one from this month, if the trend holds, it's likely to be the 11th out of the last 13 that gets revised downward at the same time that we're seeing this interesting divergence here. And if we look at the rate of change of the blended figure, the two put together, like I said, this black line, you can see we're still trending downward, commensurate with the growth rate of all prior recessions since 1966. If I look at this, yeah, right. Okay, I don't have my other chart here ready. So we're still watching this process play out. Job growth is continuing to slow down on a rate of change basis. You can see that over here. Let me zoom in on this. 2022. You can see the rate of job growth. This is the black line from over here when we look at NFP. This line right here, That is this line. There is a minor uptick. This is just non-farm payrolls, right? This is I've separated out the two. This is the one I said has a lot of those assumptions. It ticked up just a tiny bit because of that figure today, but you can see all of last year the rate of growth continued to slow down as we got negative revision after negative revision. So I expect that pattern will continue. Maybe it won't. I don't know. But if other aspects of labor are holding up, then I would expect those to bleed through into the larger overall figure. But that's job growth, right? And there's one of the elements, one of the risk factors that I've been talking to you guys a lot about is that I think that we have an unresolved story in the credit markets, right? We've talked about how since in this Fed tightening, we've seen loan creation out of the banks slow down faster than it pretty much ever has. Like you see this black line right here. This is the rate of growth of overall all bank loan creation out of commercial banks since the Fed started tightening almost 2 years ago. And versus every other era going way back, the only other time that we've seen credit growth slow this quickly was in 1953, which is another flu pandemic. And by this point, they had already had a whole recession and come out of it. We're still going through this process, and this is unresolved. So there's a lot of dynamics to this. I don't think we should spend the whole stream talking about everything that goes on in credit, but one of the key things to know is that since the great financial crisis, the regulators cracked down on the commercial banks and their ability to lend on a more risky basis. And so all that ended up doing, it didn't stop that behavior. It just pushed it out of the purview of the regulators. And so it's happening in private credit firms, private equity firms. Private lending, direct lending is responsible now for a lot of access to credit that smaller businesses and less creditworthy businesses are getting these days. And it's opaque. We don't see that in this number here. We don't know how much it's growing. We don't know where all the risks are. And many of those businesses, as we've seen in news stories that we've talked about here on the stream, many of those types of loans are for the sole purpose of deferring interest costs and pushing refinancing further into the future. All these businesses are trying to avoid refinancing at today's interest rates because the new cost of money is significantly higher than the last time they accessed debt 2 and 3 years ago when rates were 400, 500 basis points below where they are today. That is this chart here, which we've spent a lot of time on, right? Well, I had the opportunity in a Twitter space just a few days ago to talk to Dr. Lacey Hunt. He used to work at the Dallas Fed. He's a very well-known economist, and he's someone whose work I admire. He's not always been correct about everything that's happened in this cycle. He underestimated inflation when it first started occurring, and he underestimated the resilience of the economy. But he's a very smart man, and he has more experience in economics and markets than I have being alive as a human being. The man's like 80 years old. But I had a chance to ask him about my thesis about corporate America not refinancing yet, and that I think that we don't know all the risks. So I want to play for you. It's about 5 minutes. I'm going to play for you a clip from that Twitter space from just a few days ago where I asked Dr. Hunt what he thinks. And the reason I'm playing it for you is because A, it was cool for me to fanboy out and talk to someone who I've read a lot about and read from, but he agreed with everything I had to say. So I'm going to play this clip for you.
Okay, thank you. TXMC has a question, I think, the Cotina.
Go ahead, TXMC. You're on with Josh Jelinski, the financial quarterback, and Dr. Lacey Hunt. We have just about 8 minutes left, 7 minutes left with Dr. Hunt. So if you have a question, let us know. We'll try to get you on. Go ahead, TXMC.
Thanks, Josh. And thank you, Dr. Hunt, for giving us time today. I really am a big fan of your work.
I'm going to let the whole clip play. The first couple of minutes is me like setting up my question. You guys know how I am. I can't just say things in 4 words. So I set up my question for him, explaining to him the factors that I think are important. And then I ask him my question, how does he assess the risks? And then we'll listen to what he says.
One of the things I've been doing some research on and trying to learn about, pay a lot of attention to, is credit. And I think going into 2024, one of the stories that has not yet been resolved and we don't know the outcome of is the refinancing of corporate America at the new cost of money, which predominantly has not happened at the speed of this tightening cycle. And we've moved so far away from where rates were when corporate America last accessed credit in mass.
Talking about this,
the delta between that and what the market's
right
optimistic expectation of Fed cuts for next year is, leaves a pretty interesting story as to what's going to happen to a lot of businesses that need to access debt in the next 12 to 15, 18 months. And when you look at the rate of growth of bank loans, you talked about this earlier in your chat, the rate of growth of credit, of bank credit, of business loans, all of these things have slowed down in this Fed tightening cycle, which is about 20, 21 months old. Have those rates of change have halted faster than any other era going back to the 50s. To about, you have to go back to 1953, 54, which is
right here,
ironically a flu pandemic, to find another time when the rate of change of credit slowed down this quickly in Fed tightening.
Where everything we do on this channel is backed by data. Everything I ask people is backed by the data that we look at together here.
And all of those instances when it's even come close to this kind of a halting of the credit edifice has led to a recession, as you well know. And so what I'm kind of wondering about heading into this next year is how does that story play out? The delta between what the market thinks the Fed is going to be able to cut in a cycle when we have had inflation, and what is actually needed for corporate America's refinancing not to be punitive based on their current rate, right? And how much of that financing, maybe just in the last couple of years especially, has actually been pushed out of the commercial banks and into private credit, where we're not seeing it on these business loan and series on the Fred website, right? Like, that's a more opaque market. And I see all these stories in Bloomberg about how banks are offloading a lot of their risk into private credit, how more riskier businesses are accessing lending in that market, direct lending. The guy from the CIO from Castle Lake just the other couple months ago, he said that he thinks that direct lending is now 50% of the leverage loan market now, and it continues to grow. And we don't know all the risks associated over there. The risk is more concentrated than it is in like the syndicated markets, where the banks used to do most of the loan origination. Since the GFC, as the regulators cracked down on that on the commercial side, that behavior didn't just stop, it just spilled out of the walls of the regulators' purview, and now is with private lending, which has grown. I think now it's $1.5 trillion. So I'm just wondering, I'm saying all these points.
I use that $1.5 trillion figure. The bank have 7.
Yeah, so my question for you, sir, I guess, is just how are you thinking about these risks, as particularly with private credit, and how do you think the story with corporate America needing to refinance at the new cost of money will play out over the next year?
Well, I don't see it in equilibrium because the rates are materially higher, and the pace at which the Fed will be able to bring the federal funds rate down will be more measured. Because the inflation rates, the lagging indicator, will still be above the Fed's target until we get into the, probably mid-year. Maybe it'll be a little sooner, but it might be a little later. So the Fed's response will have to be measured. But your point is very well taken. I see the situation in the same terms you see it, and keep in mind that the number that I'm using is that there's about $1.2 trillion of debt that has to be refinanced. And now some of that's held by the banks, some of it's held by the non-bank sector, but the non-bank sector needs funding from the banks too. And it's not just the fact that the loans are maturing, and the prime rates of borrowing are higher, is that a lot of the folks that took these greatest risks have their credit quality has deteriorated. And so they're going to have to they're not going to borrow at the same credit-worthy rate in 2024 that they borrowed at in 2020 and 2021, early 2022. And so the rate will be higher, but I believe, and I assume from what you're thinking as well, is that there are a lot of folks that are not going to be able to obtain refinancing.
Yep.
For a variety of different reasons. In other words, the process of the Fed reversal is not going to come in time to avoid the potentiality of this adjustment process being strung out and carried over beyond 2024, perhaps well beyond 2024. But I see the analysis the same way you did. In fact, I think you expressed it better than I did. Congratulations to you, sir.
So that was my talk with Dr. Hunt. It was very brief. I didn't get to ask him another question because he ran out of time, but I liked that he complimented me on articulating my view. He said I articulated it better than he could. I doubt that, but he agrees with my assessment of the credit risks. It just adds, when I see all these news stories, I mean, go back and look at the last two streams if you missed them. We talked about it a lot. We read some Bloomberg articles talking about the explosion of lending in these markets and how they differ from what banks used to do. And I'm not saying that that the risks and whatever's going to happen this year is only going to be born out of this one corner of lending or anything like that. My real overarching point about any of this is just that we are not operating at 5.5% Fed funds today. The economy, businesses, households, borrowers across the spectrum are still operating in this world here, in the 0 to 2.5% Fed funds world, because this happened so fast and it went so far. And what has ended up happening is now that businesses are trying to delay joining this world up here as much as they possibly can by taking out debt to pay other debt, by being even more creative with the covenants and the structure of the new lending that is being done. Anything to avoid refinancing now, here, today. I talked about a little bit of this in a tweet yesterday. As banks have pulled out of small business and consumer lending, private capitals filled the void. Stiff competition has lowered standards, and borrowers are pulling every lever to avoid refinancing at the new cost of money. Everyone's betting on a quick return to normal. So we've got Wall Street firms. Wall Street wants to let junk firms pay interest with more debt. Take out debt to pay debt. That's peak Ponzi-nomics. Struggling borrowers turn to private credit to defer interest. Private credit helps private equity peers by making deal financing portable. So they have come up with new ways of allowing debts to be moved forward rather than having to be resolved today. Private credit lenders giving up protections to win bigger deals. Competition with banks spurring weaker safeguards. So underwriting is getting more aggressive, and many of these businesses are doing whatever they possibly can to avoid having to join reality here today, right? To avoid having to join this world. And because of the existence of inflation in this cycle, regardless of what it's at today, the fact that it was 9% 18 months ago necessarily changes the calculus in this cycle. The fact that we have secularly tight labor markets, right? Unemployment is like 3.7%. We had inflation in this cycle. We have all of these over-indebted businesses, and none of them have rolled into the new cost of money yet. This saga is not resolved. And as Dr. Hunt confirmed, because inflation has been here and because it itself is lagging, the response function of the Fed will be slower. They will be more cautious because inflation is their number one nemesis. The economy is continuing to grow. Atlanta Fed GDP now. The economy is continuing to grow. Q4 GDP is expected to be 2% plus. We have positive job growth. So why would the Fed cut all this much? They probably won't. So it is highly likely we will see more defaults this year. We are in a delinquency cycle. Transitions into serious delinquency for auto loans, for everyone, for groups under the age of 40, they're at the highest levels they've been since the GFC. Credit card delinquencies for groups under the age of 40 are at the highest levels they've been at since the GFC and continuing to rise. Bankruptcies are continuing to rise. And you've got all these firms, because of the stories we've looked at again and again and again, like this story here, rate cut pivot can't come soon enough for debt-strapped companies. We are not done with this story yet, and it will play out this year, I believe. Now, I don't know if commercial real estate is the biggest risk. I don't know if corporate America and the less creditworthy elements of it that are borrowing direct in these ways, I don't know if that's where the biggest risk is. I don't know if it's in the sovereign space. Maybe it's the pension funds who have been allocating to private debt, and maybe they haven't assessed all of the risks. I don't know what it is. Maybe it's all of the above. But what I try to impress is that just because the Fed is declaring victory doesn't mean that victory has been achieved. Just because they've shifted their tone in recent meetings doesn't mean that the outcome has been determined or is assured. It just means that they have shifted their tone, and their behavior is likely to shift as well. They're probably done raising rates unless we get an acceleration in inflation. But as long as the economy continues to move forward, if inflation comes back down, GDP stays positive as far as we can see, and the labor market doesn't just completely collapse, the Fed will have very little recourse to cut rates very much at all. You know, one of the biggest arguments for them cutting rates is, oh, well, they've got to keep real rates steady, right? Because if you have real interest rates and you want to keep them around 2%, but inflation keeps falling, then the interest rate needs to also come down for real rates to stay in the same place. Well, just in the last few weeks, real rates have come down a lot. They're down 90 basis points from the high. So the idea that the Fed has to cut just for this to stay in place is losing ground because the market is easing financial conditions for them, right? It's doing the work for them. Look at the 10-year. Look at the 5-year. So the Fed doesn't have to cut as much as the market even thinks they do to achieve normalcy. It's already happening. Well, this is some of the fastest easing of financial conditions absent a Fed cut that we've ever seen, right? This is pure market loosening. This is not policy loosening. So I do not think that 2024 is going to play out the way the market is currently priced. It is priced for 6 or 7 cuts, and I don't see that happening unless we get significant labor weakness, in which case that's a different story. That's no longer strong economy with Fed cuts. That's weak economy with Fed cuts. That's recessionary. So that's unresolved. And so that's why I remain reticent on declaring victory. And I see a lot of people who think that because the Fed is done tightening and we haven't had a recession, that means that victory has been declared. And I just can't disagree with that any more stoutly than I do. And so there was a guy, is it the CalPERS guy? CalPERS. Wait. It's CalPERS. Is it CalPERS? No, that's the other. It's the other. It's the other pension fund. So I was reading a story last night. I'm not going to go find it. I was reading a story about the number 2 largest pension fund in the U.S. I think it's the California Teacher State Pension Fund, and the CIO who runs the pension fund, was on Bloomberg, and he was saying how he thinks that the Fed nailed the soft landing, and his whole reason for thinking so is because the Fed sounds like they nailed the soft landing in the November FOMC. This is a man who manages hundreds of billions of dollars of people's pensions, and his determining factor in whether or not the economy avoids recession is how the Fed sounds about it in November. And it just blew my mind. Like, these are the people who are managing our money. And this guy he's taking his cues from Jerome Powell. He doesn't have his own framework for assessing these things the way that we do. And I see a lot of that behavior. And a vast majority of my timeline seems to be convinced of a particular outcome over the next 6 to 9 to 12 months. It's a very bullish outcome. Maybe they're right. That would be amazing. I am net long, so I would benefit. But when everyone seems assured of a certain outcome, when they're all sitting on one side of the boat, it becomes really easy to tip the boat over and for everyone to be wrong and get wet. So I don't really know how it's going to play out. And that, I know that's kind of an amorphous way to look at it. It's not based on any singular data point, but sentiment is part of the market, and sentiment is overwhelmingly biased towards one particular outcome. And fewer people are still holding on to the possibility that we're not over yet, that this isn't done yet. This isn't resolved. We're not out of the woods. I remain in that camp, as you all well know. And so I'm going to take a pause here. Let me drink some water. Let me catch up on the chat. And then there's something else I want to talk about, but I'll take a breather here so we can make a smoother transition. If you're not subscribed to the channel, please make sure you do that already. If you haven't hit the like button, that's the easiest way for you to support the channel while you're here. Hit that little button with the thumbs up. It takes 2 seconds. You can have it done before I finish this sentence. There's 93 likes and I've got 200 viewers. So I need about half of you to click a little button for me, and that would be amazing. Let me see what I've missed in the chat here. We got a couple of new members. Crypto Lolik, AC, Abdullah, Silent Do Good. Welcome everyone. Silent, I think I recognize your avatar from Twitter, my dude. I think I've talked to you before, but I won't dox you here. Welcome everyone to the channel. It's very generous of you. Those of you who have decided to purchase a channel membership or who were gifted one will be able to join in the members stream that we do after this. So once we wrap up this, and then, I'll probably wrap up in the next 30, 40 minutes, we'll decide on the time for the member stream. We'll probably give me 30, 45 minutes to rest. And then we'll do a member stream and we'll just we'll shoot the shit and we'll see how it goes. Okay. So if you want to be a part of that sometime in the next 30, 40 minutes, get yourself a subscription. It's only $5. You don't have to, totally not required. We'll continue to do these public streams, but it's just a little something extra to do if you want to support me, and it's my way of giving back to you. We'll do a private one. So just let's step back from recession, no recession for a moment here. And let's think about the themes that have defined our lifetime in the markets. Really, because I believe that from about 1980 or so until, let's call it the pandemic, we lived under a certain consistent global regime where there were certain kinds of outcomes that consistently occurred. And that's because of a broad directional trend in the global economy. And I believe that we're at a place now where those themes are beginning to shift in ways that maybe we don't fully understand. And it could be a few years before it's obvious. And two of those themes are very closely related to each other. And they have to do with 40 years of falling interest rates and 40 years of increasing globalization global participation, accommodative trade agreements. Those really defined basically my whole life. You know, I was born in the early 80s. I'm what is that? What does that make me? An early millennial, I guess. And basically from that point, that was from the period of the 80s after Paul Volcker killed inflation by jacking interest rates up to 20%. From that period onwards, we've had consistently lower interest rates with each subsequent crisis, right? Here's short-term interest rates going back to the 1800s. Here's Paul Volcker's era right here. And since 1981, interest rates have structurally declined over time, right? They've never set a higher high until just recently. Just now, in this past year and a half, we finally saw the federal funds rate peak above the high from 2019. It's the first time we'd really had that happen. I mean, I guess you could call that a higher high. But there wasn't a subsequent trough in between. There was here. There was a total reversal of policy. And this dynamic, coupled with the rise of modern globalization and the modern supply chain, allowed for certain dynamics that I think will necessarily be different as we move forward. And they were encouraged by the ability of the central banks and their willingness to continually lower interest rates in the face of crisis. But we're now at the zero bound. We've hit the zero bound, and we spent the better part of the last decade at the zero bound. There's no lower place for inflation or for interest rates to go unless we push them negative, which I don't think is going to happen in the U.S. anytime soon. And when you look back through time, this isn't the only time we've gone through this kind of an elbow turn in interest rates and in globalization. We've had these undulations over time. And usually when they occur, they catch people by surprise. Folks find it difficult to envision a world that operates in a different dynamic from the one they just came out of because they occur over multi-decade swings. And I think that we may be at one of those moments here because we just spent, call it 10 of the last 15 years at the zero bound globally. And we even had negative rates in certain places like in the EU and in Japan. And we've now reawakened inflation. And, oh, by the way, many of those arrangements that defined the globalized world for the last 20 years, even, not even all the last 40, many of those arrangements are starting to change. The U.S. is no longer accommodative to China, whereas they were for much of the 2000s and 2010s, first part of the 2010s. But around the period of the second Obama administration, the U.S. started pivoting its position and its stance on China. And then throughout the 2010s, we saw those dynamics start to turn a little bit. China's rise and their unwillingness to play second fiddle to the U.S. started to change some of those dynamics. We saw in the Trump administration, we actually saw the rise of new trade wars and tariff wars, where we hadn't had those between the U.S. and China, the world's two largest economies, up until that point. And now we're at a place where the bifurcation between East and West is much more apparent. Arrangements are changing. People are reassessing who they do business with. And over the next few years, many of the trends and dynamics that were consistent for the years up into the pandemic and the couple of years afterwards will necessarily be different. And I don't think they're fully understood. And I think that a lot of it has to do with China and its role, both in the last 20, 30 years, and what they may be able to do moving forward, at least as far as the West is concerned, right? Because this is really a relationship between China and, call it, the United States. We can say the West, but really it's about the U.S. and China. So I pulled up some of my tweets here because I want to show you some charts and just kind of talk through what I'm thinking about. Because I think about this stuff a lot, and I'm reading about it a lot, and I just find it fascinating how we seem to be at an inflection moment, but we have a lot of people arguing about whether or not we are just returning to the quote-unquote normal of the prior 15 years. You see people waiting for a return to normal. That's why we have That's why we have this dynamic where businesses haven't refinanced and everyone's expecting cuts all the way back down close to the zero bound because everyone's hoping for a return to the lowflation, global cooperation era that we just left. And they haven't recognized that we may be leaving it behind for something new, something that just looks fundamentally a bit different. So this really began, if you go back to the 90s, right? The dissolution of the Soviet Union, the fall of the Berlin Wall, basically the broad defeat of communism. Those things opened up Eastern Europe and subsequently China to the rest of the world. And Western economies started to benefit from these pieces of the world that had been closed off to them in large part for many generations. And so what ended up happening basically from around the early 90s through the early 2000s is the labor force in China and Eastern Europe was added to the global labor force. And the amount of people that existed in those two regions was larger than the entire developed world labor force put together. So for the 90s and 2010s, the global labor supply as a whole was gifted like 120% dividend of supply. And what that allowed the global economy to do was push wage growth way down. It stifled competition for labor because suddenly it was abundant, particularly low-skilled labor. And you have all these multinational companies, particularly in the US, who saw these opportunities to improve their margins. And they not only became complicit in this, but they, in a lot of ways, financed the deindustrialization of their own economy. And they allowed labor to be pushed out to places like China. And China became the growth engine of the Western world. Now, we had some benefits from that. One of those benefits is that we were unable to generate any inflation despite a ton of money printing, particularly after the Great Financial Crisis. We were able to see cheaper and cheaper consumer goods in certain areas, particularly like electronics and things like that. The price point of those things has become much more affordable. However, wage growth has been stifled. And as a result, also, the manufacturing sector of the U.S. broadly has been hollowed out and is a shell of what it used to be. Many of those dynamics are now reversing. This labor dividend, you can see here, the blue line represents China and Eastern Europe. The red line, AEs, is advanced economies. That's like US, Canada, Europe, Japan, all put together. And the labor forces of those two regions that were added in were larger than the labor force that existed before then. So if you think about a market, right? Like let's pretend Bitcoin. If suddenly, just magically, another 20 million Bitcoin were just suddenly created and put into the market, what would happen to the price of Bitcoin? It would go down, right? A lot. Not just from the reflexive oh shit reaction of the market, but necessarily mathematically because the supply would have doubled, right? The supply relative to the existing demand would have doubled, and so the price will go down. The same thing happened to labor costs, to wages. Your and I's ability to earn and earn more next year than we did last year and to demand higher raises from our employers. Those were necessarily affected because we had a massive labor dividend in parts of the world that previously were untapped. And multinationals were more than happy to oblige. When China joined the World Trade Organization in 2001, they had an immediate exponential impact on the growth of world trade, seen here in this black line. It was already rising. It's kind of always rising over time, but the rapidity of its rise dramatically changed when China was allowed to enter the World Trade Organization. and they were considered a friendly economy to do business with, despite the fact that they are command and control communists, despite the fact that they use capital controls and they don't have an open economy, an open capital account. We still saw them as an opportunity, and it greatly increased the lubricants of world trade. At the same time, they started buying a lot of U.S. debt. They became the largest holder of U.S. debt. China is this darker blue line you see shooting up here. Japan is the lighter blue in the background. Japan has been one of the U.S.'s closest allies for a very long time, since shortly after World War II, to be honest with you. And they were the largest holder of U.S. treasuries for a long time, and they are now today. But for a period of time, China was the largest holder, and it's because they were scooping up our debt in record amounts, particularly after the GFC. They stepped in to help finance U.S. deficits. And as a result, they accumulated a massive amount of foreign assets and foreign exchange reserves. Well, that high was reached in like 2014. And since that period, their holdings of treasuries have stalled out, and they've been slowly declining over time. Some of this decline here in the last couple of years is because of interest rates rising, but the other part of it is because they have been slowly net selling their treasuries to get cash. And as we have increased our opposition to China and our adversarial interactions with them, they've become even less interested in financing our deficits into the future. And so they have almost disappeared as a marginal buyer of treasuries. That dynamic is fundamentally different. They were one of the major rescue artists for the U.S. economy after the GFC. They funded our deficits. That's what this line shooting up starting right here is. This is the GFC. You see that? Look at the inflection point right there. Now, obviously, Japan bought a lot of debt. Everyone was loading up. After the GFC, there was a ton of liquidity entered into the market. Every central bank in the world just became a QE factory. But China was the main story here. Their growth of their holdings grew, I think it almost tripled. Yeah, almost tripled from 2008 to 2014. And there was some research that found that as we increased trade with China up here in the top, that they had a negative deflationary impact on CPI. That as we exported more and more of our manufacturing, despite all the money printing, as we allowed them to produce more and more of our goods, it had a net negative impact on CPI to the tune of 1 to 1.5% for every 1% increase in trade that we did with China. Well, that increase took place, you can see here, from the 90s all the way up until around 2015, 2016, 2017. And then U.S. imports from China as a share of all of our imports have been slowly declining since then. So the arrangements are beginning to change a bit. But we still have people assuming that we're going to go back to this era right here, where cooperation with China was increasing, where their net deflationary impact on us, the reflective exporting of deflation, is going to return. And I don't think that that's true. When you look at China's demographics, they're actually getting worse than we thought they were a couple of years ago. So one of the really appealing aspects of moving everything to China was they had so many laborers, right? They have the world's biggest population. I think now India actually might be slightly above them. But the point to really drive home about China is that they cannot continue to be the growth engine of the world the way they were before because their demographics have reversed. And they reversed right after the pandemic. You see that? Working age population projections. The dotted line was 2019. The solid line was 2 years ago, and it's below the 2019 line. Their working age population is plummeting. The birth rates have completely fallen apart. Their one-child policy absolutely devastated fertility rates. And they also have a lot of youth unemployment, which isn't really helping their economy. But that growth dividend, this already happened. It's over. It's not happening again. This dynamic, increasing trade with China, having a net deflationary impact on U.S. prices, That is over. It has reversed. Their demographics are getting worse. They're not going to have a new impulse of labor supply. We caught them literally at the crest of the wave. This was when we expanded into China the most, was right here. Oops, that's a shitty circle. Right here. Literally the crest of the wave. This is over. This right here is over. It's not happening again. So how can we return to that same world? We probably can't. And there's a fundamental linkage between interest rates and globalization. So what I want to do now, I'm going to read this to you, and then I'm going to share a couple of excerpts from the book that this is from, because I think that this is an important concept to pay attention to in this decade, because I think it is very relevant and not fully appreciated and understood. This is from the book The Price of Time by Ed Chancellor. A feedback loop exists between globalization and interest rates. More trade between countries tends to reduce inflation pressures and weaken the bargaining power of labor, both of which have an impact on the level of rates. The first wave of globalization, which dates from the 1860s to the end of the 19th century, was accompanied by mild deflation and falling long-term interest rates. Right here. This was 1870. Here is 1900. Interest rates broadly were declining. Now it's choppy. This is 150 fucking years ago. But broadly, interest rates declined into the beginning of the end of the 19th century here. During the recent globalization phase, from 1980 onward, China and other developing countries grabbed an increased share of world trade. Traded goods prices declined and millions of manufacturing jobs were offshored to emerging markets. Thus, globalization reduced both inflation and wage growth, which in turn allowed Western central banks to reduce interest rates, thereby spurring the greatest bull market in bonds in history. This paragraph just described everything I just explained. Traded goods prices came down, manufacturing jobs were offshored, this lowered inflation and lowered wage growth. Yet the decline in interest rates also propelled globalization. Globalization propelled lower rates propelled globalization. Since international credit is mostly denominated in dollars, when the cost of borrowing in dollars falls, multinational companies are inclined to construct longer supply chains. In the era of easy money, global manufacturing took place across several continents and multiple countries, 6 on average. Lengthier supply chains tied up vast amounts of working capital and required ample financing. Manufacturers in emerging markets benefited the most from the lengthening of supply chains. Overextended supply chains require accommodative monetary conditions. Maverick tech billionaire Peter Thiel adds a sobering thought. He says, all great historic bubbles, from the Mississippi bubble to the current day, coincided with advances in globalization. The previous quarter century produced a string of bubbles and busts that represent different facets of a single great boom of unprecedented size and duration. Either globalization succeeds, or it's the final and greatest bubble in history. Now, I don't really agree with this last sentence here. We're never at the last bubble in history. I can promise you that. But this dynamic, I think, defined the last 40 years. And if I'm correct that we are at an inflection point, we are at an elbow turn in these dynamics, both because interest rates hit the zero bound and because we have exhausted our cooperative dividend from working with China so closely, because those two things have been exhausted and we are now in a more adversarial posture against them. Those dynamics cannot be expected to return in the same form. But we still have market participants positioned and expecting for everything to just go back to the way it was before, including with inflation. And I just don't know that we'll actually get those things. Let me share a couple more excerpts from this book, The Price of Time, that add a little more color to what we're talking about here today. Beijing responded to the global financial crisis by launching a massive economic stimulus in November 2008. That's what I told you, right? When I showed you this, how they started buying a ton of our debt, that coincided with a huge stimulus program out of China. The stimulus carried a headline figure of 4 trillion yuan, which was 12.5% of their GDP. Most of the money was supplied by Chinese banks. Over the course of 2009, credit expanded by more than 30% of GDP. Wow. Although China's current account surplus declined after the global financial crisis, its foreign exchange reserves doubled from 2008 to 2014, reaching a total of more than $4 trillion. Oops. I have a couple more clips here. Hold on a sec. As a share of GDP, China invested more than any other Asian country had ever attempted. This is throughout the 2010s. As investment climbed to unprecedented levels. Excuse me, I got the hiccups right on cue, guys. As investment climbed to unprecedented levels, the efficiency of that investment, what economists call the incremental capital to output ratio, spiraled downwards, meaning all those immense sums spent on bridges, high-speed trains, and roads were failing to generate the much-touted improvements to productivity. Many new apartments in China were sold as concrete shells, known as blank houses, that lacked basic amenities such as electric wiring and plumbing. Many remained in this unoccupied state for years on end. In 2010, it was widely reported that some 65 million properties connected to the power grid were not using any electricity. Later estimates suggested that a fifth of all urban housing stock was unoccupied. China was said to have enough empty properties to house the entire population of Canada. China's real estate bubble threatened the country's economic miracle by lowering productivity growth and fueling corruption. So when China stepped in 2008, they started buying up all of our debt and running massive stimulus. They had to put that money somewhere. Now, some of it went to building out manufacturing capacity, and as I'll mention here in just a moment, it led to overcapacity, where they had far too much supply, and that is how they began exporting deflation. I'll talk about that in a second. But as a result of all of this money flowing into China from outside and their stimulus, they built up a lot of misallocated capital and malinvestment. And the more that you try to drive growth with additional debt, the less and less you get out of it, right? The more dollars of debt are needed to produce a dollar of GDP. And that multiplier was plummeting in China as their debt grew. And so they just started pumping it into everything. Started building roads, bridges, high-speed rail, all these high-rise apartment buildings, big commercial real estate high-rises. And after a while, they were far exceeding the productive demand capacity of their own economy. And they ended up with a lot of unproductive uses of that debt. And that has led them to a place where today they are not capable of driving global growth in the same way. And they will have to go through a period of readjustment. So when the cost of borrowing is low enough, even the most absurd investments can appear viable. Let me find this part I wanted to read to you guys. The waning contribution of credit to economic growth matched the declining efficiency of investment. This was only to be expected since most of their investment was financed with debt. What made China's growing indebtedness egregious was that its economy remained relatively undeveloped, with average incomes still far below Western levels. The rapidity of credit growth also exceeded most earlier credit booms. In the 10 years from 2005 to 2015, China alone accounted for half of the world's total credit creation. This borrowing binge constituted history's greatest credit bubble. Between 2008 and 2018, Chinese households doubled their level of debt relative to income and ended up owing more than American households did at the start of the subprime crisis in 2007. Over that same period, Chinese companies borrowed $15 trillion, accounting for roughly half the total increase in global corporate debt. In effect, hold on a second. The trickle of defaults continued. One could only guess at the scale of China's bad debts. One bank analyst suggested that by 2017, up to a quarter of all bank loans in China were non-performing. This estimate was over 5 times the official figure out of the government. If losses don't manifest on financial institution balance sheets, they appear via slowing growth and deflation, said one analyst. Debt deflation, as Irving Fisher points out, occurs after too much debt has accumulated. Here's the key part. At the same time, the excess industrial capacity produced by all of this investment was putting downward pressure on producer prices and leading China to export deflation abroad. For instance, by dumping its surplus steel in European and U.S. markets. Corporate zombies added to the deflation pressures. Despite the soaring money supply after 2008, consumer prices hardly budged. By November 2015, the index of producer prices had fallen for a record 44 consecutive months. If China's investment had been remotely productive, then it would have generated the cash flow needed to pay down its debts. But for the economy as a whole, this wasn't the case, so the debt just continued growing. A decade after the stimulus launched in 2008, China's Great Wall of Debt had reached 250% of GDP, up 100 points since 2008, and there was still more to come. So China is in a really tough spot. That, again, those excerpts are from The Price of Time. The Price of Time, Edward Chancellor. This book right here. And so China's in a place now where they're extremely over-indebted. And I found a story from Bloomberg, it was a few months back, where it says China's doing everything it can to avoid falling property prices. As private developers pulled back on land purchases, provincial governments have stepped in with off-balance sheet borrowings to scoop up properties. They're called local government funding vehicles. Those became common after the Great Financial Crisis, which helped to lubricate China's epic infrastructure projects, what we've been talking about. Those entities, those provinces, which are essentially just government offices, they bought over 50% of new land sales just in 2022. The cities were essentially selling land to themselves at reserve prices just to avoid lower bids, which reset their asset values. Many of these projects return far less than their projections, and Bloomberg estimates that 17 of the 31 Chinese provinces have debt exceeding 120% of their revenue. So China, more than half of Chinese provinces are literally underwater today. And that was not the case the last time they rescued us from a financial crisis. Now, I'm going through all this stuff because I think it's important to have this perspective. I think it's important to understand that interest rates have fallen for 40 years and they literally hit the zero bound. That is a wall. And they hit the zero bound around the same time, during this period of time, we stopped cooperating with our number one trade partner, and we've actually become adversarial with them, to the point now where other nations are rewriting their trade agreements in a lot of ways, particularly around energy and raw materials. A lot of those things are changing. And so that introduces inflationary pressures. That is net inflationary. If we're not going to get the labor dividend that we saw back here, that is a net inflationary factor that is different from the prior 20 years. if we're not going to continually increase our trade with China and have them export deflation back to us because of their overcapacity, that is a net inflationary factor. If we're going to pull manufacturing back towards new allies or back even to our own shores, or pull them to allies or to new factories here on our own shores and start paying American labor to produce things that used to be produced in China, those costs will necessarily be higher, at least initially, right? Until efficiencies are built in and things settle back down, those costs will go higher. And where we're at right now, we have awakened inflation. We have extremely tight labor markets, and wage growth is at 4.5%, 5%, depending on how you measure it. It's twice the inflation target. So I think it will be really difficult for us if this dynamic is true. I think it'll be really difficult for interest rates to keep going down, which is what has been the rescue mechanism for the central bank every time we've had a crisis and they needed to spur new growth. They just lowered rates even further than they were before. They reduced the cost of financing below what it was before, so everything was cheaper. They can't do that anymore. We hit zero. It doesn't get any cheaper than this. So if interest rates have gone all the way down and hit the zero bound, even if the next 10 years look like this, let's say we don't turn around and start going higher on interest rates. If it's just we came down and maybe we're just like this for a while. Maybe they go up, they come back down, they go up, they come back down. This dynamic is necessarily different from the one we just left. It's necessarily different from this one, where interest rates were able to continually go lower and provide a dividend to financing costs, to provide a boost to financing costs. The same way that we've been talking about this dynamic here, right? This is where's my pen? This is zero. We can't go below here like we have all the times before, right? 1987 crash. Rates went, oops. Sorry, I'm jumping around, guys. Rates went below here, went below the low. 1990 recession, tightening cycle, cuts below the low. Cuts GFC below the previous low, below the Greenspan 1% low from 2003. There is no lower than zero. Not in the US, not for the reserve asset. They're not going to have zero rates. I don't think so. So if this dynamic has changed, if rates have come down, hit a wall, and they just necessarily have to be more volatile because all of these other dynamics have changed, that is a world that no one is really positioned for. It's a world that no one alive today really has any experience dealing with because they can't imagine it, because it hasn't existed before in their lifetimes, right? Like I was born up here, like 82, 83, this window. This is where I came into the world. I have only known falling interest rates, secular falling interest rates, secularly increasing globalization and trade cooperation. If you think that any of those things are changing, then the markets will change. Correlations will change. The relationships between interest rates and the markets will change. And I think that we're going through that period now, right? This fall in interest rates, it created so many other sub-dynamics of risk-taking, of asset allocation, of portfolio construction. All of those things were built in this era. And all of those things will necessarily have to be recalibrated to whatever the future is going to look like. So let me go back to one other quote. This is again from The Price of Time. Listen to this closely. Turns in the bond market occur infrequently, only once every several decades, and when this moment arrives, most experts are taken by surprise. That's what we're talking about here, right? 40-year rise in interest rates. They turned at the Volcker era, 40-year fall in interest rates. Now they may be turning here after the pandemic. Will they rise for 40 years? Will they look like this and chop around? I don't know, but they can't look like this. They cannot look like this. So something is different. In 1899, the president of Equitable Life solicited opinions from respected American financiers on the future course of long-term interest rates. At this date in 1899, bond yields had been falling for decades, right? 1899, right here, bond yields had been coming down. This is short-term rates. Let me do long-term rates. Short-term rates. Here's 1900. They had been falling for decades. See that? Like it pales in comparison to this over here. But let me go back before this era. But if this is all you knew, look at that. Rates fell for 30 years from the 1870s. Maybe they were even falling before that. Maybe they were higher. At this date, bond yields had been falling for decades in 1899. The sages of Wall Street assumed this trend would continue. Of the 69 responses received by Equitable Life, not one person anticipated any change. The Treasury Secretary at the time, Lyman Gage, held the view that interest rates were headed permanently downward. Gage was wrong. The bond bull market had already ended, and over the following decades, Treasury yields rose. The bear market in bonds that commenced at the end of the 19th century coincided with the reversal of globalization. That's what we're talking about right now. The bond bear market that started in 1945 followed a period when U.S. interest rates had been kept at artificially low levels. Let us fast forward. Let us fast forward our chart. Here is the Great Depression. Here was long-term rates during the 1940s. Let's go back to looking at short-term interest rates. Fuck it, we'll just put it down here. Here's short-term interest rates. They were held at around 0.3% for a long time. That's what you can see down here. And that began a long period of rates rising. Well, what have we just experienced? Our own trough that doesn't look all that different from this period here. Now, the economy was different. The world was different. But interest rates just did that for a long period of time. The bond bear market that started in 1945 followed a period when interest rates had been kept at artificially low levels, and the Fed lent directly to the American government to finance the war effort. Inflation returned with a vengeance after the war, and Treasury yields rose for the next 3.5 decades. It's not hard to draw parallels between these periods and the COVID conjuncture. That's what we're doing right now. We're drawing parallels. Stepping down from his role as the Bank of England's chief economist in 2021, Andrew Haldane warned that the balance of risks was tilted towards inflation. The central bank's role was to remove the punch bowl when the party got started. If we keep pouring the punch, tomorrow's hangover will be bad. By that date, too much punch had already been poured. As globalization reverses and China's workforce declines, their workforce declines, inflation is likely to pick up, and interest rates will have to rise to contain it. Claudio Borio, who is a famous economist at the BIS, has something he calls an epoch-defining seismic rupture, a cataclysmic change to the economic surface. A toxic mixture of high inflation, financial trade protectionism, and stagnation. That no longer seems like such a distant prospect. This parallel is right here, is what we were just talking about. Let me zoom back out. Back here, interest rates had been falling for decades. And at the time, people didn't think that the trend was reversing, but it was. The bond bull market was over. The initial period of global trade cooperation and expansion, that had largely run its course. And we were entering a new paradigm where yields were going to rise for the next 20 years, and no one actually believed it was true. Ask yourself if you think there's any chance at all. We're in our own version of that. It won't be the same, but we're in our own version of that today. And it's all of these charts we just looked at. The labor dividend of the 90s and early 2000s, 120% of global labor supply added in immediately. shot wages way down. Multinationals went, holy shit, that's a lot cheaper. Let's go build factories in China. Fuck US workers, fuck their wage growth. Let's go put our factories over in Shenzhen and we'll just save a ton of money. World trade exploded. China's consumption of US debt exploded. They become the number one marginal buyer. Increased trade cooperation between the US and China until the middle 2010s allowed deflation to be reflected back to us. But now their demographics are fundamentally weakening. And as I just read to you, they have a serious debt overhang where they have massive portions of their economy, over half of their provinces, have debt exceeding 120% of revenue. So, to sum up, the past 4 decades, globalization fueled long-term interest rates falling. Falling long-term interest rates begot more globalization. The offshoring of manufacturing reduced costs and created massive inflows to China. Those massive inflows had to go somewhere and eventually led to Chinese industrial overcapacity, as well as a bunch of useless investments, as I read to you. That Chinese overcapacity created a supply glut, particularly in resources, that kept producer prices low as they exported deflation back to the West. And that labor dividend that I've talked so much about starting in the early 90s helped keep wage growth down. All of these dynamics have seemingly exhausted their shelf lives at the exact same time. Now, a global secular regime shift to an era of higher baseline volatility for costs, growth, and thus interest rates is likely ahead of us. Many may not acknowledge the turn until much later, stuck waiting for a return to their version of normal. Memories are short, and recency bias is powerful. Everyone's waiting on the return to normal. Everyone assumes the Fed will cut. They'll cut rates all the way back down to zero, just like they have every time before. They'll cut them below zero. They're going to go all the way back down because rates have to keep falling, right? Just like these guys thought. Rates just have to keep falling because they've been falling for decades. No one anticipated any change. But the bond bull market had already ended. And over the following decade, Treasury yields rose. That was 120 years ago. When you look at the indebtedness of the globe, this is debt to GDP at the top. Each of these circles is an individual country. The thick black line is the US. The blue line is the median of all nations. It's been rising. It's now at the highest level it's been in a long time. The US debt to GDP is continuing to rise. The number of countries with 100 or 120% debt to GDP is rising, structurally increasing through the 2010s. Countries running massive deficits. This is now deficits to GDP. Those expenses are getting bigger. The chart going down means deficits are growing. The black line is the US. The blue line is the median of all G20 countries. Deficits are getting wider, including in China. China has more debt to GDP than we do. And their demographics have cratered. Their real organic growth is no longer there. That's why Chinese stimulus is unlikely to be bullish for US markets and the US economy, because they are in a debt deflation spiral over there. And it's very unlikely any of that will bleed back out into us because they're just trying to prop up their own markets and avoid having a bunch of provinces go belly up. So I know I threw a lot at you guys here. This was like a big topic to try to talk about in like a 30, 45 minute span. But I've been reading about these things now for a couple of years and trying to build out my thinking around this. So maybe I take for granted just how much this encompasses. But I can't help but thinking that we're at one of those places where a bunch of the different forces in the economy are all turning at the same time, you know? Because like the world economy, human societies, it's all just a bunch of individual forces, and they're all moving in generally the same broad direction, right? You've got culture, you've got politics, you've got labor strength and demographics, you have interest rates, you have trade agreements, you have geopolitical arrangements. Like they all kind of move in like the same general direction. Technological innovations, credit creation and risk taking and all those things, right? And once in a while, and all of these forces together, all moving in one direction, they make up human society, right? It's just a big interwoven organism. All the different countries, the different market forces, everything kind of connected together. And when you get inflection points in one or more of these forces, when they happen at the same time, those tend to be periods of crisis and dramatic change societally, right? When you get 2 or 3 lines all kind of inflecting at once while the others continue moving, then it creates a reverberation, right? Like the strumming of guitar strings. And when we have these inflections, when 2, 3, 4 things inflect at once, we have periods of crisis. We can have recessions. We can have economic downturns. They can also be dramatic change to the upside and booms and euphoric periods. But alas, it creates higher volatility, right? So for the last maybe 15, 20 years, much of the advanced world has kind of all just been going in this one direction, right? Everything's just been kind of very slowly, very smoothly kind of transitioning in one general direction. Well, now demographics are turning, interest rates are turning, world trade cooperation is turning, geopolitical agreements are beginning to turn, right? The demographic strength in multiple countries is beginning to turn. China, Japan, Europe, the US, Canada, they're all beginning to turn. And at the same time, asset markets around the globe are at all-time highs. So maybe they're beginning to turn. Who knows? Maybe they go higher, maybe they don't. But the point I want to make here is that all of the guitar strings, all of the forces that make up human society and this big interwoven organism, a bunch of them are all turning at the same time in this period we're in now, in the 2020s. And that opens the door for the potential for dramatic change, for incredible volatility that no one really can forecast or anticipate with accuracy. It doesn't have to mean there's a Great Depression. It doesn't have to mean that. That is certainly possible. But what I think it does mean, and what I said in my tweet over here, this one, is an era of higher baseline volatility, right? Higher baseline volatility. Rates can't continue going lower. They've hit the zero bound. Rates have hit the zero bound. They can't just continue going lower and rescuing us like they did for 40 years. They have to do this now. Or, God forbid, start doing this. This dynamic is a sea change difference. It is a tectonic reversal in the dynamics that defined the last 40 years. And until it becomes obvious, if I'm correct, until it becomes obvious, any momentary period that feels like a return to the prior era of normalcy is going to be celebrated by the markets, and they're going to get out ahead of their skis, and they're going to declare that we have returned to normal and everything is back to the way it was. Victory has been achieved. Let's all pat ourselves on the back. But as we've now spent the last 45 minutes exploring, a great many things are different. And it is far too early for us to assume, and there's frankly very little precedent for us to assume that we are going to return to this era here in every way. And I just want you guys to spend some time kind of thinking about that. Let me catch up on the chat here. That was a long rant. David gifted a membership. Thank you, David. You've been very generous gifting memberships to the homies, helping to get this going. Cyprian, welcome. Mike, welcome. Romek, Minto, welcome to the channel, guys. All of you will be able to join in the member stream that we will do after this. Mike joined the Founders Club. Hey, big spender. Welcome. Thank you so much. I really appreciate you guys showing support to me, showing me some love. I try to return as much as I can back to you guys with what I'm looking at, what I'm thinking about. Hopefully it's valuable. Let me go back in the chat, see if there's any big questions I can try to answer as we're starting to wrap up here. When long-term yields go down, is it because the market expects lower inflation for the duration of the debt? So lowering yields on a 5 or a 10-year means the market expects inflation to remain low? Partially, yes, Alessandro, I think so. And, you know, it's because the 5-year and the 10-year are set by the market. They're not set by the Fed, right? The Fed only sets short-term rates. Everything else gets traded, right? From the 2-year basically onwards, all of those get traded by the market. And so it's the market's opinion. And I think when you think about how many cuts, FedWatch, when you think about how many cuts the market is anticipating for 2024, which you guys already know what my opinion is on that, I think it's excessive. The market's expecting multiple cuts through the end of the year, all the way down to 400% Fed funds. That's 150 basis points of cuts, 175 basis points of cuts in that range. That I think the 10-year is trading on that. It's saying, oh, the Fed's done tightening. We don't have to see a 10-year yield over 5%. Whew, we dodged a bullet. Everyone, let's bid TLT because the Fed's done hiking. And I don't think it's really about inflation. I think it's about expectations that the Fed is going to return to normal on interest rate policy, and that we're just going to go right back to being in the 2010s again with a 10-year at like 3.5%. I think that's unlikely to stay that way. Doesn't mean we can't revisit those areas and be there for a period of time, but I think the secular trend is turning, and that it will take a few years for it to be obvious. And in the meantime, you will see celebration of the return to normal anytime the market sniffs it out. And I think as soon as the Fed pivoted their tone in November, they clearly changed their tone. And it's obvious now that they're probably done hiking, barring a major surprise. The market's now trading on the return to normalcy, right? We talked about that last week quite a bit when I showed you the interest rate expectations for different countries and how wrong they were, and how they all expect hundreds of bips of cuts this year in the next 12 months. Everyone is betting on the return to normal trade. And I think that's what you're seeing. Treeman asks, do you believe cuts will come in Q3 rather than Q2? I don't really know. I don't know when the Fed is going to cut interest rates, how much. I think it'll be less than the market expects. I don't know when the first one is. I'm not even going to really even try to guess that. I do think they will cut something this year. Will it be this much? I seriously doubt it. And that just means that all these people holding on up here are fucked. Because, like, look, this is the Fed funds rate here. This is the next 4-5 years of Fed projections of the Fed funds rate. Here, see these? This is what it actually is right now. This year, next year, the year after, the year after. Now, this is based on a survey of all the Fed governors, these projections. It's not them saying this is where policy will go. It's just their opinion. It's not a forecast. But the thing to pay attention to is that the Fed doesn't even think we will get below the high of 2019. You see that? Compare that to this chart, where the high is right here. This spot right here at the top of this yellow box is exactly where they think Fed funds is going to stall out at next year, in 2025. So we're not done with this saga yet. 2024 probably has some surprises in store for us. Awesome intro. Thanks, Anthony. I appreciate that. Will we see a 702 reversal? Asks XP Market. Excuse me. I don't know if we'll see a 702 reversal. We might see one of those on Bitcoin. I think that's certainly possible. We're really close to that level, but we're not quite there yet. 702 is at 53K. Right now we're still down here at around 43 and a half. We'll find out. I've long thought that like this is kind of going to be near the high for BTC on this retrace move that we've been waiting for a really long time. It hasn't come. It's finally coming now. And this isn't that far away at the same time that as I've showed you guys this a lot, and anyone who is friends with my good buddy Blockchain Backer, you've seen similar analysis on this. Like the NASDAQ is near the top of a 20-year cycle, right, as far as Fibonacci's go. Right as we're looking at Bitcoin maybe finishing a retrace, another 10K higher. So this is a really interesting spot. And we've got those economic forces that aren't resolved yet. So I'm very hesitant about 2024. This is game time for me. I spent all of 2023 talking about what I thought would happen at the end of the year. I was a little bit untimely in that I wasn't talking enough about how bullish the market was during that period of time, but I was preparing myself for this window of time right now. And here we are, and everything is lining up. It's got me more nervous than ever, to be honest with you. How to pay to become a member. I will show you. If you go to my channel, there's a button that says join right there. There might be one in the chat somewhere. I'm not sure about that because I see it differently from y'all. But if you go to the front page of the channel, there's a join button at the top. There should be. And if you do that, again, it's totally optional. We'll continue to do these streams. But if you join that, you can be part of the member streams. And we're going to do one about 30 minutes after this one today ends. And we're going to wrap up here in the next few minutes. Big Shroom donated $5. 100K subscribers soon, bro. Love your work. Thanks, Big Shroom. I hope so. We're getting close to 20K. We're at 19 and a half. I'd love to see 20,000 before the end of Q1. It feels like it's growing really slowly. That's okay, though. If you haven't hit the like button, please do so. We don't have 200 likes, but we got 200 viewers. So I'd really like to see those two both have a 2 at the beginning of them. There's also a join button below the title if you're watching the stream, someone says in the chat now. Mad respect for your knowledge. It's nice to hear real life statistics, not just Moonboy up and to the right content. I appreciate it. The reason that I stick so much to this data, and maybe it frustrates people who want me to be more excited. I'm not excited, like I'm long the market. But I see a lot of times where the mob is just dead wrong. A lot. Particularly Bitcoiners get things wrong a lot about market direction. Maybe not about the long-term trajectory of fiat or anything. Like they'll probably be right about some of that stuff over the long term. But on a short-term basis, people get really excited. They get fixated on the wrong things, and they get carried away by narratives. And when I hear people who manage billions of dollars not really having the kind of awareness that I would hope that they would have, CalSTRS, that's what it's called. I'm going to find it for you. CalSTRS. Yeah, here we go. So this guy, CalSTRS, he manages this guy, Chris Ailman. He's the CIO of CalSTRS, and they are the second largest, I think, investment firm, the second largest pension firm in the U.S. I'm not gonna be able to find the link here, am I? Okay. Here it is. So not that long ago, Chris Ailman was saying he thought there'd be a 50% chance of recession. He said this in July of last year. He said, I've been saying that for a year, and I've been flat out wrong. When interest rates climb, somebody's got to get hurt, but we're not seeing the pain we would expect. That's what he said in July. And then there was another story, which it might not show up here in video. It might not show up here, but I found it last night, and it was from him as well. Okay, I'm going back too far in the past. But he came on Bloomberg in December, just last month, and the same guy who 6 months ago said, I think there's a 50% chance of recession in 2023, but I've been calling for it for a year, meaning he started calling for it in summer of 2022, and he's been wrong. He came on Bloomberg in December and said the Fed has achieved a soft landing. And the reason for that is because, listen to them. They sound victorious. They're probably done hiking, and we haven't had a recession. So now that they're done hiking and we're not in a recession, it must mean we're not going to have one. So 2024 is going to be great. That's what this guy said. Well, anyone who follows my channel here knows that's not the right answer. Just because the Fed says they're done doesn't mean it's over, right? Like what qualifications do they have for telling us we are or aren't at the end of the cycle? We have examples of recession out in front of us, multiple. And job growth is continuing to slow down. There's plenty of signals. Credit is completely choked off. But because the Fed changed their tone in November, this guy who manages hundreds of billions of dollars also changed his tone. And I see a lot of that kind of thing in the market everywhere. People assume that because the negative outcome hasn't happened now, it must not have happened. The Fed's done hiking. Everything's over with. But you guys know that's not how any of this works. And most of the time when the Fed gets done hiking, which is the solid lines, job growth continues to slow down for many months afterwards, which is the dotted lines, which is the change of employment after the Fed is done tightening in each of these cycles. What do you see all the dotted lines doing? Drifting downward months after Fed tightening is over with. So we've got all these people declaring victory. We're only 20 months into a Fed tightening cycle. They average 24 months. Recessions begin on average another 8 months after that. And everyone's declaring victory here today. But I don't think that that's going to be accurate. New Bitcoin all-time high in 2024? I don't think so, checkmate. I will be surprised if that happens. I don't think Bitcoin is going to have an all-time high in 2024. If it does, great. I have some Bitcoin in cold storage. But in my trading account, I will take profit at these levels. I will sell some of my BTC. I will sell some of my ETH. I'll sell some of my other things and de-risk into the retracements here because it's what I've been watching for 2 years. And we're finally getting there. Alessandro says the Fed's done hiking because they're afraid of having done too much. That's very possible. That is possible. But we won't know if they've done too much for a bit more time. So it's now 12:45 p.m. here. We're going to wrap the stream up here. I'm going to close down here in the next couple of minutes. If you haven't hit the thumbs up, please do so. Thank you for your support. If you are a member of the channel, we will do a live stream in 30 minutes. We'll do it at 1:15 Central Time, my time. That's 30 minutes from now. As soon as I end the stream, I'll create a new video link that's scheduled for 30 minutes from now, and you'll see it show up. And it'll say members only on it. And we'll hang out. I don't have a big agenda for that one. That one I kind of want to be more unstructured and kind of have a bit more back and forth with you guys and spend less time monologuing. So that's my intention for the first one at least. And we'll do that, like I said, 30 minutes from right now. Oscar asked me opinion on the leading economic indicators, consecutive months of decline. Yeah, so the conference board has a bunch of indicators that have been declining for many months, and it's like 20 months or something like that. It's telling a story, but a lot of it is softer data, like survey data and things like that. So it's hard to attach it directly to outcomes. And in a period of high inflation, sentiment is really negative anyways. So I think it's interesting, and I think it will eventually be proven correct. But the fact that it's been declining for 20 months at this point, it's kind of lost some of the signal there in terms of how to time the cycle. Like, you can see that it's still declining and that leading indicators are still very negative, but they haven't manifested in all the coincident indicators going negative. So that's really what you have to look for now, right? Leading is continuing to confirm. Coincident hasn't yet confirmed. Michael says he's on iOS and he's not seeing the join button. So I don't know if anyone in the chat can help Michael out, because I'm on my desktop and I see something slightly different from you guys. So I don't know exactly what that looks like. But I do know that if you go to the front page of the channel on desktop, like I did here just a minute ago, there is a join button on there. Let me look. You know what? I'm going to open my stream from my phone real quick from my personal account, and I'll take a look and see if I can detect where the button is for you guys. Because if I don't see it, then we'll both be screwed. Let's see. Maybe you can't do it from mobile? Is that possible? Maybe you have to do it from desktop? Bunch of dudes trying to find the button. Yeah, I just want to help you guys out. Like, if you're trying to join, I want to try to figure it out for you. I'm looking here on my phone, and I also do not see the button. So I see what you're seeing. If I go to my channel, in YouTube mobile, I also don't see the join button. I'm only seeing it on desktop. I will Google this afterwards, and I'll try to come up with a better answer for you, Michael, and whomever else might be having that problem. And I'll try to get back to you with an answer. But right this second, I don't have an answer. David says to join on desktop, press Alt F4. Don't do that. That will close your browser. Someone says it's at the bottom of the video. So maybe that's true. Here we are we're all sitting here like trying to find this one silly button. Yeah. Sorry guys. Sorry I can't be more help right off the bat here. But in your opinion, what are some assets that can protect us in times of high inflation and a busted stock market? That's a hard one to answer, Rupert, because nothing really does super well. But in times of crisis and in times of higher elevated inflation, typically, I have to emphasize typically, you want to be as close as possible to real assets, be as unlevered as possible. Things like commodities tend to do well. Things at the front of the supply chain tend to do well because those increase in costs trickle down to everything else. So that is typical. But, most of the time in a downturn, cash is king, at least in the initial stages. And then the more liquidity sensitive things can start to recover first. Like gold tends to bounce early. Bitcoin might bounce early if COVID is any kind of example, but who knows? So anyways, we're going to end here. Got 25 minutes before we do our member stream. I'll create a video for it right after this, and you'll see it show up in the feed if you're looking for it. If you can't join on mobile, try to open the channel on desktop and look for the join button at the top of the channel page, or maybe someone will gift you a membership, and I'll try to figure that out for next time. I really appreciate all you guys hanging out and supporting me We will continue to do this through 2024. And yeah, I hope you guys have a great weekend. The next stream will probably be next Wednesday or Thursday. Today was Friday, but I was traveling earlier this week and I needed a couple of days to kind of get my bearings. So end of next week, we'll do another stream, and I look forward to seeing all of your bright faces and bushy tails then. So until the next time we meet, take care of yourselves. Take care of your families and your pets. Call your mom. Touch grass. Don't listen to Jim Cramer. Don't get too excited about the ETF. It's a great thing. It's not going to change our lives overnight. But I am pretty excited about it. I think it'll be cool. I think it'll be a great thing long term. And we'll chat again in just a few days. Members, look for that video coming up here in just a minute. Thank you, everyone. I'll see you next week.